Welcome to the Deep Dive, where we take a complex stack of sources and pull out the critical insights you need to be informed. Today, we are opening up one of the last true mysteries of modern finance, the AI black box.
It really is the core tension in financial technology right now, isn't it? I mean, we have these incredibly powerful, highly accurate machine learning models. They can predict things like credit risk almost perfectly.
But they can't tell you why.
Exactly. They can't tell you why they made that prediction. You get this high-stakes answer, approve or deny, invest or divest, but you get zero defensible reasoning behind it. That's what people call the accuracy versus interpretability trade-off.
And in the world of investment, of lending, where every single decision has to be audited and justified, well, that black box is a total non-starter. You can't just go to a regulator and say, the AI said so.
You really can't.
So our deep dive today focuses on how leading researchers have started to solve this using something called explainable artificial intelligence, or XAI.
Yeah, we're looking at a really rigorous XAI methodology.
Yeah.
It was applied to a real-world data set of 2,049 Italian small and medium enterprises, SMEs. The mission was, well, it was really clear.
Yeah, okay.
Predict investment risk and expected return. And then, this is the key part, use XAI to clearly explain the specific financial levers driving those outcomes for every single company.
So we're not just predicting the future, we're getting the user manual for why that prediction holds true. And the framework for this uses a very accurate prediction algorithm, extreme gradient boosting.
XGBoost, yeah.
XGBoost. And it's paired with this sophisticated explanation method, Shapley values.
And that combination is absolutely key. You need the raw power of XGBoost to get the accuracy, but you have to have the elegance of Shapley values to crack it open.
Okay, so let's get into how they orchestrated this, because it's not like they just mashed the two together. They built a strategic sort of two-stage filter. If you're a portfolio manager, what does that repeatable workflow actually look like?
It's structured to handle failure first, which is smart. The first objective is always risk management. So they use XGBoost to estimate the probability of default, the PD, for every company. That's stage one.
The risk prediction.
That's the risk prediction.
Yeah.
And then stage two immediately explains that risk. Precisely.
Zero.
They calculate these Shapley values to identify, company by company, the financial indicators, loans, turnover, leverage that are most heavily driving that specific risk prediction.
So once they have that list of high-risk firms,
They apply the filter. They only proceed with the companies the model predicts will be non-defaulted. It lets them focus resources on the viable investments.
that just makes sense. You don't want to waste time calculating the potential return of a company the model thinks is going to fail next year.
Right.
So for the survivors that get past the filter, how did they move from, say, simple profit after tax to a real measure of expected return?
So that's the calculation in the second stage. They estimate the expected return, or ER, by taking the company's profit after tax and adjusting it by the probability that the company won't default.
So it's fundamentally a risk-weighted profitability measure.
It is. They're manually discounting the profit based on the credit risk that the firm still carries, even if it's low.
That feels critical. It's not just about how much they make, but how reliably they're going to make it. And then I assume they use XAI again on that new metric.
Exactly. They run the Shapley values one more time, but now it's applied to the expected return. And this helps determine the significant factors influencing profitability. It separates the drivers of success from, the drivers of mere survival.
So to just quickly summarize the tools here, XGBoost is the powerful predictor. It's chosen for its speed and accuracy in these complex jobs. It's the powerful kind of opaque engine.
Right.
But what exactly are Shapley values? Why are they seen as the ultimate key for transparency here?
It's rooted in cooperative game theory, which I know sounds incredibly dense. But the concept is so powerful because it's model agnostic.
What does that mean, model agnostic?
It means it works regardless of how complex the underlying XGBoost model is. It can explain anything.
Okay, so for a decision maker, how do I translate that into a tangible benefit? What does Shapley actually do?
Well, think of it like this. Imagine the prediction, the final risk score, is a prize. And the financial indicators like turnover, leverage, and loans are the players who work together to win that prize.
Okay.
Shapley values are a mathematically fair way of dividing up the winnings. It calculates the contribution of each feature by testing it in every possible combination with all the other features.
So it's not just saying, oh, turnover is important. It's quantifying with mathematical certainty that for this specific company, turnover contributed, say, 42% of the reason its risk score was high.
It assigns an exact credit or blame to every single input, and that's the kind of transparency you need for true auditability.
Now, once they had the right tools and this methodology, the researchers faced a much more fundamental problem, and it was with the data itself. The study looked at the 2018 balance sheets of these 2,049 Italian SMEs to predict their default status a year later. What did they immediately notice?
The critical challenge was the class imbalance problem. Out of those 2,049 SMEs, only a tiny minority, just 6.8%, had actually defaulted. The vast majority, 93.2%, survived.
And this is where it gets really interesting and frankly a little terrifying for anyone building financial models. You could build a completely simplistic, naive model that just predicts no one ever defaults.
And it would be 93.2% accurate.
Right, but it would be totally useless.
That's the trap. That model is statistically accurate, but it would miss every single failure event. And that's the exact scenario a banker and investor is trying to identify. It's a catastrophic data bias.
It sounds like a guaranteed way to go bankrupt if you rely on it. So how did the researchers make sure their powerful XGBoost model didn't fall into this trap?
They used a technique called SMOTE. It stands for Synthetic Minority Oversampling Technique.
Okay. In plain English.
In plain English, they didn't just throw out the skewed data. They artificially created new synthetic examples of the minority class, so of the defaulted firms.
So they were essentially teaching the model what failure looks like by giving it extra manufactured examples of those high-risk patterns.
Exactly. And they only applied this to the training data, which is key. It ensures the model truly learned the crucial patterns of default, forcing it to look past the really obvious pattern of just survival.
That's the necessary groundwork for trust. And once they had this clean, balanced data, they rigorously selected 8 robust financial indicators as the levers of prediction. Things like turnover, loans, leverage, and net income on total assets.
And all that prep work really paid off.
Yeah.
The model's performance confirmed they'd succeeded. To assess credit risk, they achieved an area under the curve, or AUC, of 0.91.
Which is excellent.
It's excellent for distinguishing between defaulted and non-defaulted companies. It means the model was exceptionally good at spotting failure. And the expected return estimation was just as reliable, confirming its high accuracy.
So the model is accurate, and thanks to XAI, it's interpretable. Let's move to the market level findings then. If we look at the average Shapley values across all 2,049 companies, what we call the global interpretation, what did the AI say were the biggest drivers?
The global analysis revealed a crucial insight, and this is really the headline finding. The drivers of risk and the drivers of return are fundamentally distinct.
They're not just opposite sides of the same coin.
Not at all.
So if they aren't inverses, what was the most significant driver for the probability of default? For the failure risk?
Across the entire market sample, the biggest lever pulling companies toward default was turnover. Total sales revenue. Insufficient sales were, on average, the primary threat to survival.
What came after that?
The second and third most significant risk drivers were net income on total assets and then EBITDA.
Okay, so risk management starts with revenue generation. But what was the most significant driver of success, of expected return, once you filter out that high risk?
That was net income on total assets, which is a measure of efficiency. It shows how effectively a company uses its existing assets to generate profit. The second driver there was EBITDA, followed by shareholders' funds.
That is the core asymmetry right there. The risk of failure is primarily about turnover. Are you selling enough? But the level of profitability is primarily about net income on total assets. Are you managing your assets efficiently?
It means you could have a company with decent asset efficiency, but if its core sales suddenly drop, its risk profile can just explode instantly. Managing risk and driving returns require focusing on different parts of the financial statement.
They're distinct challenges.
Completely distinct.
That's the big picture then, the trend across the whole market. But the true power of XAI, as you said, is its ability to ignore the average and deliver the local interpretation. This is where you get the personalized financial story for every single company.
Yes, and that individualized explanation is the core strategic advantage. The global analysis might tell you that turnover is generally the biggest risk, but local XAI shows you why this specific company failed or succeeded.
Can you give us an example of how this kind of shatters traditional analysis? We know in general that insufficient turnover is the biggest risk driver.
Right, so let's look at two successful, non-defaulted companies. The model found two completely distinct paths to financial health. For the first company, the XAI confirmed that its success was primarily due to strong turnover.
Which aligns with the market average. It's a good, straightforward story.
Exactly. But the second successful company, its stability wasn't primarily driven by sales at all. The XAI showed its low-risk profile was overwhelmingly attributed to its low value of leverage.
Interesting.
Its minimal debt burden was its key strength. That's what was keeping it stable, even if its sales volume wasn't, market leading. Traditional global analysis would completely miss that unique path to success.
That's fascinating. The AI isn't just grading the test, it's reading the notes and telling you how the student passed.
And we can do that joint asymmetry comparison for a single enterprise, which is really the most actionable insight. So take Enterprise 1. The XAI showed its credit risk was driven mostly by turnover.
Okay.
But when they looked at its profitability, its expected return was driven by net income on total assets.
So different metrics are controlling two different aspects of its financial viability.
And for another company, Enterprise 2, the primary driver of credit risk was also turnover, but its expected return was most impacted by shareholder funds.
Yeah.
This gives an investor just a surgical view. Mitigate risk over here, maximize return over there.
This level of transparency is transformative. We can now translate these technical results directly into real-world strategic advantages. For you, the investor, what does knowing these specific drivers mean for your portfolio?
It means moving past simple risk scores. It means embracing transparent, informed decisions. You can perform a much more nuanced portfolio assessment because you understand the specific, quantified factors behind every single prediction.
And for company managers themselves, this is a phenomenal diagnostic tool. If you're trying to attract investment, the XAI model pinpoints exactly which financial levers, whether it's boosting turnover or lowering leverage, must be improved.
It tells you exactly where to focus your capital and resources. And beyond the corporate level, banks and financial institutions can now build these robust, interpretable AI credit models that can be trusted internally. This moves lending past a simple approved in iBox and into actual consultation.
And crucially, supervisors and regulators get the ability to audit and validate those models. They can ensure the AI systems are not these opaque, mysterious black boxes, but transparent systems whose logic they can completely verify.
The whole methodology, by flawlessly combining the predictive power of XGBoost with the clarity of Shapley values, successfully bridges that foundational gap, the one between accuracy and transparency. It just fundamentally enhances our understanding of a company's future by illuminating the why behind every prediction.
The success of this XAI framework really does point toward a future where AI in finance isn't only powerful, but also fully accountable. The sources even suggest researchers should apply the same methodology to, say, stress test data from the COVID-19 era.
Or even conduct comparative studies against other explanation methods. It marks a complete shift from just prediction to actual understanding. Decision makers are now empowered with a clarity and a confidence that just didn't exist when these models were opaque.
And that raises an important question for you to mull over. As investment decisions become a more transparent science, driven by clear, company-specific financial diagnostics, what role is left for human intuition?
A fascinating place to leave it.
Thank you for joining us for this deep dive into how we open the financial black box. We'll be back soon with more critical insights you can't afford to miss.